What happens if the U.S. debt explodes? The United States owes more than $30 trillion. Let that sink in. Not billion, trillion. A number so large it barely feels real. Politicians argue about it. Economists debate it. Headlines warn about it. But here's the question most people quietly wonder. What actually happens if U.S. debt explodes? Does America go bankrupt? Does the dollar collapse? Does inflation spiral out of control? Or does nothing happen at all? Because here's the strange part. The debt has been rising for decades, and the system hasn't collapsed. So what's the real risk? And at what point does manageable become dangerous? Let's break it down. Look, when people say the U.S. debt, they're talking about federal government debt. Money the government has borrowed by issuing treasury bonds. Investors buy those bonds. In return, the government promises to pay interest and repay the principal later. Who owns that debt? U.S. citizens, pension funds, banks, foreign governments, and even the Federal Reserve. Countries like Japan and China hold significant amounts of U.S. treasuries. Why? Because U.S. debt is considered one of the safest assets in the world. Safe, stable, reliable. That perception is everything. Because debt only becomes a crisis when confidence disappears. In fact, it's normal. The government borrows to fund wars, infrastructure, social programs, economic stimulus. After World War II, U.S. debt as a percentage of GDP was actually higher than it is today. And yet the post-war decades saw massive growth. So what matters isn't just the size of the debt, it's debt relative to GDP, interest rates, investor confidence. If the economy grows faster than the debt, the burden shrinks over time. If interest rates stay low, servicing the debt remains manageable. But if growth slows and rates rise, that's when pressure builds. And that's where things get interesting. Here's the real risk. When the Federal Reserve raises interest rates, borrowing costs increase. That includes government borrowing. If the U.S. owes trillions and rates rise significantly, interest payments explode. The government then has three choices: raise taxes, cut spending, or borrow even more. None of those are politically easy. And here's the uncomfortable part. As debt grows, a larger portion of the federal budget goes toward interest payments, not defense, not healthcare, not infrastructure, just interest. At some point, debt servicing can crowd out everything else. That's called the debt spiral risk. And it's subtle at first, then suddenly it's not. Could the U.S. default on its debt? Technically, yes. Realistically, highly unlikely. Why? Because the U.S. borrows in its own currency, the dollar, and the dollar is the world's reserve currency. If necessary, the Federal Reserve can create dollars. That's a major difference between the U.S. and countries that borrow in foreign currencies. A country like Argentina has defaulted multiple times because it couldn't access foreign currency needed to repay debt. The U.S. doesn't face that constraint. But here's the catch. Printing money to service debt can trigger inflation. So while default may be unlikely, currency debasement is a risk. Different crisis, same consequences. If debt explodes and investors lose confidence, they may demand higher interest rates to compensate for risk. Higher rates increase government interest costs, which increases borrowing, which increases debt further. Now imagine the Federal Reserve steps in to keep rates low by buying treasuries. That's essentially monetizing the debt, creating money to finance government deficits. If done excessively, this can weaken the currency. Inflation rises, purchasing power declines, not overnight, but gradually. And inflation is politically painful because it acts like a hidden tax. It reduces real wages, it erodes savings, it shifts wealth. That's the silent danger of unchecked debt growth. Debt sustainability is ultimately about confidence. As long as investors believe the U.S. can manage its obligations, they'll keep buying treasuries. But if confidence cracks, bond yields spike, markets panic, borrowing costs surge, and things move quickly. In 2011, during the U.S. debt ceiling standoff, markets became nervous. The credit rating agency Standard & Poor's downgraded U.S. debt for the first time in history. The system didn't collapse, but it was a warning. Confidence can shift, and once it shifts, it's hard to restore. Here's the key question. If debt is so high, why hasn't disaster happened? 3 reasons: the dollar's global dominance, deep liquid treasury markets, strong economic base. The U.S. economy is massive, innovative, productive. Investors still see treasuries as a safe haven during global crises. Ironically, when global instability rises, money often flows into U.S. debt. That demand keeps borrowing costs relatively contained. But that advantage depends on continued trust. Trust in institutions, trust in stability, trust in repayment. Now let's imagine a worst-case path. Debt continues rising rapidly. Interest rates stay elevated. Political gridlock prevents fiscal reforms. Investors demand higher yields. The Federal Reserve faces pressure to intervene. If it prints aggressively to suppress rates, inflation could accelerate. If it refuses, interest payments could consume a huge portion of the federal budget. Neither path is painless. And here's where the real risk lies. Not in sudden collapse, but in slow erosion. Higher taxes, reduced fiscal flexibility, lower long-term growth, gradual currency weakening. Empires don't always fall overnight. Sometimes they weaken slowly. There is another path. If economic growth accelerates, if productivity surges, if innovation drives GDP higher, debt relative to GDP could stabilize or decline. That's historically how many countries manage high debt loads, grow out of it. But growth isn't guaranteed. Demographics matter. Productivity trends matter. Global competition matters. The future isn't predetermined, it's probabilistic. So what happens if the U.S. debt explodes? Not necessarily collapse, not necessarily default. More likely, higher interest burdens, political tension, inflation risk, slower fiscal flexibility. The danger isn't dramatic overnight implosion, it's gradual vulnerability. Debt itself isn't evil, but excessive debt combined with high interest rates and weak growth, that's combustible. Here's the real takeaway. As long as the U.S. maintains economic strength and global confidence, the system holds. If confidence breaks, the adjustment could be painful. And in a world built on credit, confidence is everything. The U.S. debt number is enormous, but the real question isn't the size, it's whether the system that supports it remains trusted. Because once trust erodes, debt stops being a number and starts becoming a crisis.